Okay, as we talk about leases, the leasing standard changed in the last few years, and so if it's been a while since you've looked at leases, some of this information is going to be new. So this first lecture just kind of hits the overview, highlights, just gives us a framework for thinking about leases as we move forward. All right, so first of all, there are advantages to leasing versus purchasing an asset. First of all, a lease really is a form of 100% financing, in that you really don't typically have any down payments when you have a lease, whereas most purchase agreements do require a significant down payment. Another advantage is that a lease allows you to turn over obsolescent items a lot more conveniently. Rather than having to buy and sell, you simply turn in the asset back into the lessor, and usually you can get a new one in its place. This is really true of things that have high turnover, like maybe computers, or depending on what you do, maybe sometimes cars, things like that, where you want a high turnover, you want sort of the newest, the latest, and greatest, without a high cost to doing so. The other thing is a lot of times leases can be written to accommodate a lot of different situations, whereas purchase agreements, they really tend to be a lot more restrictive, and so there's just a lot more flexibility with lease arrangements for most situations. And then finally, this one's probably the hardest one to sort of quantify, but sometimes a lessor can have higher tax rates. And so, for tax purposes, if they're able to keep some of those assets on their books, that may lead to a tax savings for overall, because it's a deduction from the lessor's perspective, and they can pass along some of that tax savings to a lessee. And so there is sometimes an indirect advantage through cost or tax savings. Let's take a quick look at who the lessor typically is. First of all, who is it that facilitates these? Number one is the banks. They're kind of the largest one by far, the largest lessor by market share. First of all, they do have access to funds, and so they can purchase the lease assets from the seller fairly easily. They also have economies of scale, so they can usually provide lower cost financing services, which would even include leasing costs. And a lot of times leases are fairly standardized, and so banks can kind of have a process in place that they can kind of facilitate the lease very quickly and very efficiently. Second large group is captive lease companies. They're considerable, but not nearly as large as banks. Typically, they're a subsidiary of a large company. So, for as an example, Ford Motor Company, Caterpillar, and IBM all have captive lease subsidiaries that help facilitate leases from the retail sales side. And then independents are a smaller group, and they're really only a small portion. They really a lot of times will deal in very specialized lease arrangements, and the costs are typically going to be higher than what a bank or captive lease company might charge, simply because they're just non-standard lease arrangements. All right, so let's talk a little bit about the conceptual nature of leases. First of all, a lease generally is a contract that permits the right of use to a lessee for an asset that is owned by the lessor in exchange for consideration, and usually that consideration is a cash payment. All leases that are greater than 1 year must be capitalized. And so when we talk about capitalizing, what we really mean is that there's going to be a right of use asset and a lease liability created as part of the initial transaction. This is the big change in the standard from what it was previously. So no matter what lease, as long as it's over a year, there's going to be an asset and there's going to be a liability. Both, when they're recorded initially, are recorded at the present value of the minimum lease payment, so they directly offset each other at the initial entry. There are two types of leases now under the new standard. There's finance and operating leases. The classification determines the nature of the expenses that are going to be recorded as part of the lease, and it also affects the treatment of the asset and to a lesser extent the liability. The liability is really treated the same way, but the asset is treated differently depending on the lease type. It's also important to note that the total cost of the lease is the same regardless of the classification. In other words, whether you classify the lease as finance or operating, the total costs or total expenses over the life of the lease are going to be exactly the same. What may change, though, is the nature of those expenses and how they're recorded. And so with a finance lease, there are two expenses. There's an interest expense as it amortizes the lease liability, and there's also an amortization expense for the right of use asset. That amortization expense is very similar to straight line depreciation. And then with an operating lease, there is only one expense, and that is the lease expense.